Welcome back to Talk Tickers. If you are tuning in, you know the drill by now. We are the show for the experienced investor. We're here to hunt for the signal and mercilessly strip out the noise. We are not here to read you headlines that you could have found on your Bloomberg terminal, 3 hours ago. We're here to understand what is actually moving the money.
That is exactly the mission. We're looking for the structural shifts, the things that change the way a sector works for the next 10 years, not just the next 10 minutes.
Yeah.
We want the geology, not the weather.
Right. And today, we've got a really massive one. We are doing a deep dive into the Q4 and full year 2025 earnings call for Quanta Services, ticker symbol PWR. Now, look, if you have been following the macro narrative, artificial intelligence, the energy transition, the sort of reindustrialization of the North American economy, you usually hear about the glamour trades.
Oh, yeah. Always the glamour trade.
You hear about the chip makers, you hear about NVIDIA, you hear about the hyperscalers like Microsoft and Google.
Right, the bid side of the equation, the software, the algorithms, the actual silicon.
Precisely. But today, we are talking about the atoms. We are talking about the other end of the wire. We are talking about the company that actually builds the physical infrastructure that makes all of that computing power possible. We are talking about the connective tissue of the AI revolution. And let me tell you, looking at this earnings print, the vibe check is, well, the sentiment has shifted from cautious optimism to something much, much more concrete.
It really has. I mean, we are recording this, looking at the market reaction, and it is telling a very specific story. The stock was up significantly pre-market.
Like 5 or 6%, right?
Yeah, about 5 or 6%. And it held that strength throughout the session.
Mm-hmm.
That is rare. Usually you see a pop and a fade. But here, you look at the options volume, and it was nearly 4 times the average daily volume. The market was hunting for a reason to buy this, and, well, Quanta gave them every reason they needed.
This is not a turnaround story anymore. This isn't a we hope the grid gets updated story. This is a strength begetting strength story.
Wow.
Everyone is out there buying the GPU makers, but Quanta is building the socket that you plug that GPU into. And without the socket, that H100 GPU is just a very expensive paperweight.
That's the core thesis right there.
Yeah.
And what is fascinating about this particular quarter, specifically Q4 of 2025, is that it validates the idea that we are moving from a cyclical boom where construction happens in waves into a structural multi-decade shift. We're going to get into the numbers, but the backlog number...
Okay, on the backlog number.
It's insane. The amount of work they have signed contracts for effectively rewrites the investment case for the entire industrial sector.
It is a monster number. But before we get to the backlog and the strategy, let's just hit the headline number so everyone knows the scorecard we are working with here. Because this wasn't a squeaker of a beat. This was a statement.
It was a decisive beat across the board. Let's start with the bottom line. Adjusted earnings per share, or EPS. The consensus on the street was looking for $3.02. Quanta came in at $3.16.
So a 14-cent beat.
A 14-cent beat. Now, in the world of high-growth tech, a 14-cent beat might not sound huge. But in the world of industrial infrastructure, where margins are usually super tight, where weather can completely ruin a quarter, and where project delays are just a fact of life, that is a significant margin of outperformance.
And usually when you see an EPS beat in this sector, experienced investors get a little suspicious. You have to ask, was it driven by a lower tax rate? Was it driven by share buyback engineering?
Right. Was it just financial gymnastics?
Exactly.
That is the right question to ask. You always have to check the quality of the earnings. And in this case, the answer is no. It was not engineering. This was pure operational excellence. Look at the top line. Revenue came in at $7.84 billion for the quarter.
And the consensus was what?
The consensus was only $7.36 billion. They beat the revenue number by almost $500 million. That is 20% year-over-year growth.
Let's pause on that. A utility-focused contractor, a company that literally digs holes, climbs poles, and pours concrete, growing the top line at 20%. That is usually reserved for software companies or early-stage biotech.
Exactly. That is tech company velocity in a hard-hat industry. And it tells you that the demand for their services is outstripping the general economic growth rate by a mile. If GDP is growing at 2 or 3% and Quanta is growing at 20%, they are capturing massive market share, or the market itself is just exploding.
Or both.
Or both, yeah. But what I like even more was the profitability on that revenue. Adjusted EBITDA for the quarter was over $845 million.
And cash flow. This is the metric I know you scrutinize the most because, well, in construction, profit is an opinion, but cash is a fact. You can massage EBITDA all day long, but you can't fix the bank account balance.
Cash is reality. Operating cash flow was $1.13 billion. Free cash flow was $946 million just for the quarter.
Wow. That free cash flow number is critical because it answers the capital intensity question. There is a persistent bear case on Quanta that says, oh, they have to spend too much money on trucks and equipment to grow. It is too capital intensive.
Right, that they'll grow themselves into bankruptcy.
Exactly. Well, when you generate nearly $1 billion of free cash in a single quarter after paying for your CapEx, you are proving that model totally wrong.
It removes the financing risk entirely. They don't need to go to the debt markets to fund their growth. They are completely self-funding.
Which gives them immense optionality. When you have $1 billion of cash coming in every quarter, you have choices. You can buy companies, you can buy back stock, or you can invest in your own supply chain, which we will definitely discuss later because that is a completely fascinating development. It really is. But here is the thing. You and I both know that in this market, past results are interesting, but guidance is absolutely everything. You can have a great quarter, but if you guide soft, or even if you just guide in line, the stock gets crushed. We have seen it happen time and again. Quanta did the exact opposite. They put up a monster quarter and then guided for a monster 2026.
This is the real market mover. Management provided their 2026 outlook, and they are projecting revenue between $33.25 billion and $33.75 billion. But look at the earnings per share forecast. They are guiding for adjusted EPS of 12.65 to 13.35.
Let's unpack that. What does that actually mean in terms of growth trajectory?
That represents more than 20% earnings growth year over year. So you have a company that just grew 20% telling you they're going to grow another 20% next year. This is why the stock is up 144% over the last year compared to the broader sector.
It's a lie, right?
Right, the XLI is up maybe 28%. Quanta is completely decoupling from its peer group because it is growing at a rate that its peers simply cannot match.
It is trading like a premium asset because it is performing like one. Okay, so those are the headlines. The numbers are incredibly great, but why? What is actually happening on the ground to drive this? I want to do a deep dive into the engine room here. And the first place we have to start, because it is the topic on everyone's mind, is the power for AI thesis, data centers.
This was the highlight of the call for me. For a long time, the data center narrative for Quanta was a bit nebulous. It was, yeah, we do some work there, we hook up the lines, we do some substations. It was vague. On this call, management put a hard number on it. They revealed that data centers are now roughly 10% of their total business.
10%. That is not a hobby anymore. That is a reporting segment. That is billions of dollars.
It is a totally material segment. And more importantly, they explicitly said it is the fastest growing piece of backlog. So that 10% slice of the pie is expanding faster than the rest of the pie. It is becoming the main driver.
And Duke Austin, the CEO, didn't just give us percentages. He gave us a very specific case study that I think perfectly illustrates the massive scale we are dealing with. He talked about this project in Indiana.
Right, the Indiana campus.
Right.
This is a 3-gigawatt power generation and infrastructure project for a single data center campus.
Okay, stop there. 3 gigawatts. I feel like we need to pause and really let that number sink in. Because if you are not in the energy industry, 3 gigawatts might just sound like a fictional number from Back to the Future. It sounds totally abstract. But contextualize that for us. How big is 3 gigawatts in the real world?
It is absolutely massive. To give you comparison, a typical nuclear power plant unit, think of a massive concrete reactor dome, the giant cooling towers, the whole works, might produce 1 to 1.2 gigawatts. A really large twin unit plant like Diablo Canyon might do 2.2 or 2.4. So this single data center campus in Indiana requires more power than a massive nuclear power station produces. That is the scale of the AI build-out.
So a single client for a single campus needs a nuclear plant's worth of power. That is just mind-boggling.
It is. And remember, that power doesn't just magically appear. Quanta isn't just running a little wire out to the street. They are building the generation, the substations, and the transmission infrastructure to support that incredible load. This validates the hyperscale narrative completely. We aren't talking about plugging in a few server racks in a closet. We are talking about building city-sized power infrastructure for singular clients.
Now, there was a technical detail in the Q&A that I thought was completely fascinating, and I want to make sure our listeners really understand it because it directly speaks to Quanta's competitive advantage. They started talking about the architecture of the chips themselves, specifically NVIDIA, and a major shift in voltage.
Yes, this was a great catch. There's a long discussion about the shift in NVIDIA's architecture and the power requirements moving from 54-volt systems to 800-volt DC systems.
54 volt to 800 volt, that is a massive step up. Why does that matter? Why can't they just keep using 54 volts?
It matters because of physics, specifically Ohm's law. When you need to move a massive amount of power, which these new AI chips crave, you essentially have two choices. You either increase the current, which is the amperage, or you increase the voltage, which is the pressure.
Okay.
If you increase the current, you generate a ton of heat. Resistance creates heat. Heat is the absolute enemy of data centers. It melts cables and fries chips. So to move this massive power efficiently without literally melting the infrastructure, you have to jack up the voltage.
High voltage, low current, that's the efficiency play.
Exactly. But here's the massive problem. 54 volts is relatively safe. You can work on it with standard precautions. 800 volts DC, direct current, is highly lethal. It arcs differently than AC power. It requires completely different cabling, different shielding, different heat dissipation, and vastly different safety protocols. It basically turns the inside of a data center into an industrial high-voltage environment.
So the concern from the analysts on the call was, does this change your addressable market? Does this move the work behind the meter where maybe you have less market share?
Right. They were asking if this becomes a specialized IT job rather than a quanta job. And Duke Austin was very, very clear. He said, effectively, we are in front of this architecture shift. His argument is that this massive complexity favors quanta. The average local electrical contractor, the guy who wires an office building or a local shopping mall, cannot handle an 800-volt DC architecture shift at a hyperscale. It is way too dangerous, too complex, and the liability is astronomically high.
It actually deepens their moat. It is almost counterintuitive. You'd think new tech would disrupt the old school builders, but it's actually solidifying their position.
It severely raises the barrier to entry. Quanta is saying we are the ones who handle high voltage, whether it's on a transmission tower 100 feet in the air or inside a server hall. If it's high voltage, it is our domain. They are bringing utility-grade safety and expertise completely inside the building.
So the chips are getting more powerful. They need way more juice. The juice needs to be delivered at lethal voltages. And that means you need the Navy SEALs of electricians to install it, not the guys who wire your kitchen.
Precisely. And Quanta's is the Navy SEALs in this analogy. They have the highly specialized training, the safety record, and the massive scale to do this across 50 sites simultaneously.
I love that. Okay, let's move to the next pillar of this deep dive. We talked about the AI demand. Now let's talk about the visibility. Because the scariest thing for an investor in a construction company is usually the cliff. You finish the big project, you finish the stadium, you finish the bridge, and then what? You have to go find another one to replace that revenue. It is a treadmill. But Quanta is telling a totally different story about their backlog.
This is the sleep well at night factor for investors. They ended the year with a total backlog of approximately $44 billion.
$44 billion, that is bigger than the GDP of some small countries.
It is a record.
Yeah.
But it is not just the size of the number that matters. It is the quality and the duration. Management went out of their way to frame this not as a cyclical boom where they just happened to win a few big lucky zids. They described it as a multi-decade structural shift. They are literally booking work into 2030, 2032, and beyond.
And this connects to a phrase they use a lot on the call, programmatic spend. We really need to unpack this term because I think it is the absolute key to understanding why the valuation multiple on this stock has expanded from a generic contractor multiple to something much, much higher. What is the difference between hard bid and programmatic spend?
This is the most important business model shift in the entire industry, and it is nuanced. In the old days, the hard bid world, a utility would say, we need a transmission line from point A to point B. Here are the blueprints. Lowest bidder wins.
Yeah.
That is a terrible business. It is a race to the bottom on price. Margins are incredibly thin. And if you screw up the estimation by even 5%, you lose money. It is completely adversarial.
Right. It is a commodity service. You are just selling labor by the hour to the lowest bidder.
Exactly. Programmatic spend is completely different. This is where a utility, say Duke Energy or PG&E, comes to Quanta and says, look, we have to spend $5 billion over the next 10 years to modernize our grid. We cannot bid out every single telephone pole replacement. It is way too slow, and we don't have the internal engineers to manage it anyway. We need a partner who will just handle this entire program for us.
So it is more like a marriage than a transaction.
It is an alliance. They sign a 5 to 10-year master service agreement, an MSA. Quanta gets visibility. They know the work is coming, so they can go ahead and hire the people and buy the equipment without the fear of layoffs next month. The utility gets certainty of execution. They know the work will absolutely get done. This shifts Quanta from being a construction company to being a compounding utility-like asset. It reduces the risk profile of the revenue significantly.
Which completely explains why investors are willing to pay a higher price to earnings ratio. You aren't paying for a boom bust contractor anymore. You are paying for a steady Eddie infrastructure partner.
Exactly. When you have $44 billion in backlog, and a huge chunk of that is these long-term programmatic alliances, your earnings volatility drops like a stone. And in finance, when risk drops, value goes up. Wall Street pays a massive premium for low volatility and high visibility. It creates what I call a visibility moat.
Now, speaking of moats, let's talk about how they are actively widening theirs. They are generating $1 billion of cash, and they are just sitting on it in a bank account. They are being incredibly aggressive with strategic M&A and CapEx. In Q4 alone, they deployed about $1.7 billion on acquisition.
It was a spending spree, absolutely, but a very, very targeted one. They bought three main entities: Tri-City Group, Wilson Construction, and Billings Flying Service.
Okay, we absolutely have to talk about Billings Flying Service. They bought a helicopter company.
They did. A massive fleet of heavy lift helicopters.
I mean, on the surface, to the cynical investor, that sounds like pure corporate excess. Like, oh, the CEO wants a private air force to fly around in. It sounds like something from the 1980s. But there's a very specific logic here regarding the critical path, isn't there?
There is. It goes back to that word we keep hearing, certainty. Why buy a helicopter company? Well, think about how you build a massive transmission line across a mountain range like the Rockies or a remote forest in Canada. You can't just drive a truck there. You have to airlift the towers, the workers, and the materials.
So the helicopter is essentially the forklift of the sky for these guys.
Exactly. It is literally the only way to get the job done. Now, imagine you are Quanta. You have a billion-dollar project on the line with incredibly strict deadlines and massive financial penalties if you are late. But you don't own the helicopters. You are renting them from a third-party aviation firm. What happens if that aviation firm has a mechanical issue? Or what if they get a better, higher-paying offer from the Forest Service to go fight wildfires? Or what if they just go bust?
Your billion-dollar project is stalled because you can't get the tower to the top of the mountain. You are completely held hostage by a vendor.
Precisely. By buying Billings Flying Service, Quanta is verticalizing their logistics. They are saying, we are not going to let a third-party vendor be the bottleneck on our execution. It is all about execution certainty. If you control the logistics, you completely control the schedule.
It is the exact same logic as Amazon buying its own cargo planes. If you want it done right and on time, you have to own the planes.
That is the perfect analogy. It is logistics as a service, but internal to the company. And then you look at the other acquisitions, like Tri-City Group. That gives them massive fabrication capabilities.
Right. And this ties into the other big investment they talked about, the $500 to $700 million they are putting into manufacturing power transformers and breakers. This is wild to me. A construction company is suddenly becoming manufacturer. Isn't that inherently risky? Manufacturing is a really tough, low-margin business compared to services. Usually, Wall Street completely hates it when service companies buy hard assets.
It is risky if you are doing it to compete with GE or Siemens or Hitachi on the open market. But that's not what they are doing. This is a direct, targeted response to the supply chain crisis we all saw post-COVID. Lead times for large power transformers went from 18 months to over 4 years. If you are Quanta and you have an ironclad contract to build a substation in 2026, but you can't get a transformer until 2028, you are dead in the water.
You can't finish the job, you can't get paid. The project just sits there 90% done, waiting for one part.
Right. And for a programmatic partner, that is totally unacceptable. So Quanta is doing something very bold. They're saying, fine, we're going to make our own. They're de-risking their own supply chain. They are investing hundreds of millions to build transformers and breakers specifically for their own projects. They aren't trying to sell them to the world. They're building them to unlock their own $44 billion backlog.
So if the industry is short on transformers, Quanta doesn't care. They have their own factory.
They have their own factory. And think about the massive competitive advantage that gives them when they were bidding for that programmatic work we talked about earlier. If a utility asks, can you absolutely guarantee you can finish this by 2027? Quanta can say yes, because we own the factory that makes the critical parts. Their competitors, the pure play engineering firms, cannot say that. They are entirely at the mercy of the global market.
That is a massive differentiator. It really turns them into a vertical monopoly on getting the job done. It creates a completely closed loop of execution. They design it, they build the parts, they fly the parts to the site with their own helicopters, and they install it with their own labor.
It creates a system where the only constraint is their own internal capacity, not the outside world. It is the very definition of controlling your own destiny.
Speaking of capacity constraints, let's hit Section 4. Because all the helicopters and transformers in the world do not matter at all if you don't have the people to actually turn the wrench. And we know there's a massive labor shortage. The silver tsunami, the retirement of skilled tradespeople, is a very real threat to this whole sector. But Quanta seems to be immune, or at least highly resistant to it.
Well, the numbers they gave are impressive. Their total workforce is now approximately 69,500.
Nearly 70,000 people. That is a small army.
It is. And in an industry facing a massive shortage of skilled craft, labor linemen, electricians, specialized welders, Quanta has positioned itself to become the employer of choice. They have programs like Veterans in Energy, where they are recruiting directly from the military. They have their own massive training campuses, like the Lazy Q Ranch.
The Lazy Q Ranch, it sounds like a luxury vacation spot.
Far from it. It is their massive state-of-the-art training facility down in Texas. They take raw recruits and turn them into highly specialized linemen. Duke Austin made a point that because they have this scale, they are winning work simply because they are literally the only ones with the bodies to do it.
That is the capacity moat. If a data center needs 500 specialized electricians in rural Indiana next month, who else can mobilize that? A local mom and pop shop can't. Even a decent regional firm can't. Quanta can deploy labor across the continent like a highly coordinated military operation.
And there's a fascinating comment Duke made about engineering and AI. He said something that I think a lot of people might have missed in the transcript, but it felt like a massive shot across the bow of the white-collar engineering industry.
I caught that too. It was about how they view the future of engineering firms.
He mentioned that they are deliberately moving away from acquiring engineering firms. In the past, they bought some engineering capacity to bolster their design side. Now, he's saying they're going to use internal AI to completely improve engineering productivity.
He basically hinted that AI might just commoditize the engineering work entirely.
Exactly. He is betting that the thinking part, the design, the drafting, the blueprints, is going to get radically cheaper and easier because of AI. Generative design can do a huge amount of the heavy lifting. But the doing part, the climbing the physical pole, the flying the heavy lift helicopter, the welding, the high pressure pipe AI cannot do that. You cannot download a physical power line.
So the value is rapidly shifting from the white-collar design work to the blue-collar execution work. The profit pool is moving from the architect directly to the builder.
That is his thesis. And if he's right, Quanta is positioned perfectly because they are the undisputed kings of the doing part. They are letting AI handle the commodity white-collar work, and they are doubling down heavily on the scarce blue-collar asset.
That is such a contrarian take. In a world where everyone says learn to code, Duke Austin is basically saying learn to climb.
And the market is completely proving him right. The backlog proves him right. The shortage of labor proves him right.
It really does. So let's zoom out a bit for the broader investor context. We have talked about the backlog, the helicopters, the AI. What is the so what for the portfolio? Because we hear the word compounder thrown around a lot on Wall Street.
We do. It is an incredibly overused term. But Quanta actually has the data to back it up. They have delivered record revenues for 8 of the last 9 years. They've delivered record EPS for 9 consecutive years. This isn't a cyclical stock that just had a lucky post-COVID run. This is a highly consistent compounder.
And Duke made a very specific point to say we have done this through different administrations and completely different economic cycles.
That is the key rebuttal to the political risk argument. Investors are always worried. They say, what if the IRA, the Inflation Reduction Act, gets repealed? What if the new administration hates renewables? What if the subsidies just completely dry up? Quanta's counterargument is remarkably simple. Load growth completely overrides politics.
The grid doesn't care who is sitting in the White House.
It really doesn't. Physics is completely bipartisan. If you plug in a 3-gigawatt data center, the grid absolutely needs more capacity. If everyone buys an EV, the grid needs more capacity. If you want to reshore all this manufacturing to Ohio or Arizona, the grid needs more capacity. That demand is pure physics. It's not policy. Policy can speed it up a little or slow it down slightly, but the overarching direction of travel is entirely dictated by physics and economics.
And reliability, too. I think that's the other massive driver. It's not just about green energy. It's about literally keeping the lights on during a major storm.
Grid hardening. replacing old, rotting wooden poles with concrete or steel, putting lines underground so they don't blow over. That work has to happen regardless of whether the power flowing through the line is coming from a wind farm or a coal plant. The wire itself doesn't care, and Quanta builds the wire.
Let's check the valuation reality here, because usually when a company buys $1.7 billion worth of stuff in a single quarter, their balance sheet gets totally blown out. They load up on debt and become super fragile. Where does Quanta stand?
That's the beauty of their cash flow engine. Even after spending $1.7 billion on all those acquisitions, their leverage ratio is still under 2.0 times debt to EBITDA.
Under 2.0x. That is incredibly conservative for a heavy infrastructure company.
It is practically pristine. They have plenty of dry powder. They could go out and do another billion-dollar deal tomorrow if they found the right target. They are not stretched at all. This gives them immense flexibility. If the market turns, they are completely safe. If an amazing opportunity arises, they can pounce on it immediately.
And the catalyst landscape has changed too. For a while, the whole story for this stock was about this one massive project, Cinzia.
Right, the huge transmission line in the Southwest designed to bring wind power to California. Everyone was watching that one single project like a hawk.
And now management is basically shrugging and saying, yeah, Cinzia is great, but we have completely moved past that.
They have totally diversified the catalyst. Cinzia is now just one project inside a $44 billion backlog. The catalyst is now broad-based load growth across the entire U.S. economy. It's data centers in Indiana. It's grid hardening down in Florida. It's renewable interconnections up in the Midwest. It's no longer a single project bet. It is a massive bet on the U.S. economy's fundamental need for power.
So we have a beat, we have a monster guide, we have a backlog that provides clear visibility for an entire decade. We have a management team that is aggressively vertically integrating to crush the competition on logistics and supply chain. And we have a balance sheet that is rock solid.
It's a very, very difficult thesis to poke holes in right now. The stars are completely aligned for them.
Which brings us to our absolute favorite segment of the show, the part where we take off the responsible journalist hats and put on the hedge fund idea dinner hats.
Yes, the wild but plausible segment.
Exactly. Disclaimer time. This is not financial advice. Do not trade on this. We are two voices on a deep dive. Not your financial advisors. Do your own diligence. But if we were sitting at a steakhouse in Midtown right now, pitching a trade to the investment committee, what is the absolute best play here?
Okay, hear me out on this one. I call this the vertical monopoly play.
I am listening.
We go long Quanta, ticker PWR. That's the easy part. But here is the critical hedge. We short the pure play engineering firms.
Ooh, spicy. Why?
Because of exactly what Duke Austin said. In a world where global supply chains break down and skilled labor is incredibly scarce, the company that actually owns the hard assets wins. The company that owns the transformer factory and owns the helicopter to physically drop it on the mountain wins 100% of the time.
And the pure play engineering firms.
They are the ones getting squeezed. They don't own the hard assets. They sell billable hours. And Duke just told us that AI is going to massively commoditize those hours. So you have the hard asset implementers, Quanta becoming absolute kings, because you cannot AI your way out of physically digging a trench.
Yeah.
And you have the soft skill engineering firms facing severe deflationary pressure from new technology.
So it's essentially a long atoms, short bits trade within the infrastructure sector itself.
Exactly. Long the guys who physically get their hands dirty. Short the guys who just draw the pictures.
I like it. And I have a kicker for you, a side bet to add to the pitch.
Let's hear it.
The billings kicker. I'm pitching that Quanta eventually spins off Quanta Aviation. Think about it. They are actively building up this massive fleet of heavy lift helicopters and specialized aircraft. Eventually, this becomes the absolute largest private air force for grid construction in the entire world.
You know, it probably already is.
Right. So why keep it buried inside a construction conglomerate multiple, spin it off, command a tech-like multiple for logistics as a service? You rent that incredible air force out to everyone else in the industry, except your direct competitors, of course.
That is wild. But you know what? In this market where specialized logistics routinely trade at 30 times EBITDA, it's not impossible. If they bundle the manufacturing side and the aviation side, they could create a grid services support spinoff that would absolutely trade at a massive premium.
It's the Air Force of the energy transition. I'm telling you, there is serious hidden value there.
I love it. It's totally speculative, but the underlying logic holds up perfectly.
All right, let's wrap this up. We have covered a huge amount of ground today. What is the final takeaway?
Quick recap. Monster beat $3.16 EPS. Monster guidance over $12.65 for 2026. And the backlog is the ultimate safety net at $44 billion.
And the final thought is just incredibly simple. The AI boom is real. We all see the chips, we all see the chat bots, but none of that works without electricity. And you can't just wish electricity into a data center. You have to physically build the line, you have to build the substation. Quanta builds the socket. It is that simple.
If you believe in AI, you absolutely have to believe in the power grid. And if you believe in the power grid, you are looking straight at Quanta.
Couldn't have said it better myself.
Yeah.
That is our deep dive on Quanta Services. As always, this is Talk Tickers. Do your homework, watch the tape, and we will see you on the next print. Signing off.
See you next time.